If you are looking at the charts right now and feeling completely bored, congratulations. You've fallen into the oldest, most effective trap set by market makers. You look at this endless sideways chop, this dying volatility, and you think the market is dead, that nothing is happening, that crypto isn't what it used to be. But while the crowd yawns, closes their terminals, and leaves the market, behind the closed doors of the US Senate right now, in March 2026, a historic battle is unfolding. A battle whose outcome will forever change the landscape of digital assets. Hello, everyone. Today we are going to break down a situation that many analysts are completely missing. They either only look at Bollinger Bands or only read the news. But the truth is, the market works differently. The real, life-changing moves are born only when a perfect technical setup aligns with a massive fundamental trigger. And today, we have exactly this kind of cocktail on our table. On one hand, an extreme contraction of the trading range. The spring is coiled so tight you can hear it cracking on Wall Street. On the other hand, a fundamental nuclear bomb called the Clarity Act, whose advancement has entered its final, most aggressive stage. In this video, I will show you where the smart money is hiding, why traditional banks are literally begging politicians to stall this bill, and how you can build your trading strategy right now so you don't get left behind when this spring finally snaps. Get comfortable. We are diving deep. Let's start with the dry language of numbers and charts. Let's drop the emotions and see what the price is actually doing. On the higher timeframes, the daily and weekly, we see a classic consolidation pattern, a symmetrical triangle, or as it's often called, a wedge. What does a chart squeeze mean from the perspective of market mechanics? It's not just a picture. It's a visual representation of the balance between fear and greed. Buyers no longer want a market buy, they place limit orders lower. Sellers don't want to dump assets cheaper, they place their ask higher. As a result, the price gets clamped in a vice. Look at the Bollinger Bands. They have squeezed to historic lows. In crypto, such extreme contraction is always the calm before the storm. Remember previous cycles. Every time volatility dropped to these levels, it was followed by an impulse that shattered all local resistance and wiped out hundreds of millions of dollars from shorts or longs. Now pay attention to the volume. It's dropping. Declining volume in a tightening pattern is a textbook sign that retail investors have lost interest. They are bored. They went off to trade meme coins or went back to the stock market. But ask yourself, if the crowd has left, whose money is forming these massive support levels that the price bounces off every time there's an attempted dump? The answer is obvious. Big capital institutions and market makers are in a stage of aggressive but hidden accumulation. They are soaking up liquidity like a sponge. A sharp pump right now doesn't benefit them. They need to build their positions while you are sleeping. Look at this liquidation heat map. Right above our current resistance, massive clusters of stop losses have piled up from those shorting this sideways range. And below support, a sea of liquidity from the longs. The market is fully loaded, the fuel is in the tanks, but for the rocket to launch, it needs a spark. It needs an excuse that will force fund algorithms to hit the buy button. And this excuse is currently being forged not on the exchanges, but in Washington. To understand the scale of the impending explosion, we need to rewind a bit. Since the very birth of Bitcoin, the crypto industry has lived in a state of schizophrenia. We have two main regulators in the US, the SEC and the CFTC. And for years, they've been playing a bureaucratic tug-of-war. Dev teams, exchanges, and funds lived in constant fear because the SEC could show up at any moment and say, your token is a security. Here's a fine, a lawsuit, and a delisting. This was called regulation by enforcement. No clear rules, only retroactive punishments. And then, in July 2025, a historic event occurs. The U.S. House of Representatives passes H.R. 3633, known as the Clarity Act, and it passes with massive bipartisan support, 294 to 134. Even Democrats who were traditionally crypto skeptics voted yes. What does this bill do? It finally draws a clear, concrete line. If an asset is decentralized, if it's a blockchain that runs on its own like Bitcoin or mature altcoins, it is recognized as a digital commodity and falls under the jurisdiction of the CFTC. But if it's a token sold by a centralized company to raise capital, it stays with the SEC. For crypto, this isn't just news. This is the holy grail. The Clarity Act outlines clear rules for exchanges. Now they can register as digital commodity exchanges and legally list assets without fearing that agents in suits will raid them tomorrow. The bill even creates a safe harbor for DeFi developers and network validators. Do you realize what this means for institutional money? Until now, many pension funds, sovereign wealth funds, and massive asset managers haven't touched anything beyond Bitcoin and Ethereum. Why? Because the word uncertainty made their lawyers go gray. They can't invest billions into a space with no clear legal status. The Clarity Act gives them that status. As soon as the bill is signed, the floodgates will open. The trillions of dollars currently sitting on the sidelines waiting for a green light will pour into the market legally, fully regulated, and transparently. But hold on. If the law is so great and already passed the House back in July 2025, why are we currently, in March 2026, still waiting? Why has the price on the chart coiled into a spring instead of shooting to the moon? Welcome to the real world of politics and big money. The bill got stalled in the Senate, and the reason isn't the SEC, and it isn't the CFTC. The reason is the traditional banking system, which suddenly realized that crypto is about to pull the rug out from under them. Let's call a spade a spade. Banks are terrified of stablecoins. Last July, the Genius Act was passed, legalizing stablecoins as a payment method, but it banned paying direct interest on them to protect the banks. But crypto is smart. The Clarity Act in the industry found a loophole: the concept of rewards for holding assets, rather than traditional banking interest. Think about it. Why would you keep your dollars in a traditional bank account for a laughable APY when you can hold a regulated digital dollar in your own wallet and earn transparent, higher rewards through blockchain or DeFi mechanisms? The bankers figured this out. To them, this is a threat to lose hundreds of billions of dollars in deposits, so they turned their lobbying machine up to the max. Just last week, on March 5, 2026, the American Bankers Association officially rejected a compromise offered by the White House. They are trying to block the Clarity Act to prevent crypto companies from getting the status and the right to compete with them. But the crypto industry is fighting back. Realizing that the bill is stalling in the Senate, crypto firms right now, this spring, are rushing en masse to get national bank trust charters through the OCC. It's a genius move. If Congress stalls, crypto says, fine, we'll just become banks ourselves. This conflict is not a bearish signal. It's the strongest confirmation of the value of cryptocurrencies. Banks wouldn't spend millions on lobbyists if they didn't feel that the Clarity Act was the final nail in the coffin of their monopoly. And that nail will be hammered in. It's only a matter of time. Now let's put the puzzle together. Technicals plus fundamentals. We see volatility drop to 0 on the chart. Price is squeezed in a tight range. Why? Because big capital doesn't trade randomness. Smart money knows that the Senate right now, these very days, is holding backroom negotiations on the Clarity Act. The markup sessions in the agriculture and banking committees are the real battlefield. Institutions don't buy resistance breakouts on a 5-minute chart like retail traders do. They build their positions in advance, during the chop. They use the fear and exhaustion of the crowd to buy up every dip. How does the breakout from such a coiled spring usually happen when a news trigger hits? Here's the scenario you must be ready for. As soon as news breaks from Washington that the Senate has agreed on amendments or that the bill is heading for a final vote, we will see an explosion. But be careful. Often, right before the real takeoff, the market maker paints what we call a Darth Maul candle. A sharp squeeze down to hunt the long stop losses below the bottom of the triangle, shaking out the weak hands. And only after that, the price reverses and smashes through the upper boundary, triggering a chain reaction of short liquidations. When the Clarity Act is finally passed, it won't just be a catalyst for a single green candle. It will kickstart a macro trend. The transition from the Wild West to a regulated digital commodity market is what we've been waiting 15 years for. This is on par with the launch of spot Bitcoin ETFs, but the scale is broader because it affects the entire market, including altcoins and the DeFi sector. So, we know the chart is squeezed. We know the fundamental trigger the Clarity Act is ready to fire. What exactly should you do right now to make money and not lose your portfolio? Rule number 1. Stop trading the noise. If you are trying to scalp inside this tight converging triangle with 50x leverage, you are just feeding the exchange with fees. In an accumulation zone, you need to act like a whale. Build spot positions at the lower boundaries of the range. Rule number 2. Portfolio positioning for the Clarity Act. Think about who the main beneficiary of this law will be. First, Bitcoin. It will 100% get digital commodity status under the CFTC. That's the foundation. Second, major infrastructure altcoins and layer 1 networks. If their blockchains are deemed mature and decentralized, they escape the SEC's crosshairs. Their repricing potential is colossal. Third, the DeFi sector and stablecoin infrastructure. Yes, banks are fighting them, but the safe harbor provisions in the bill will untie developers' hands. Decentralized exchange and Oracle tokens could become the top gainers once the regulatory shadow disappears. Rule number 3, risk management. I already mentioned fakeouts. Don't go all in on the very first green candle movement. Split your entries. Keep some fiat on the sidelines in case of a manipulative downward squeeze driven by bad news, like if the Senate delays the vote again. In politics, things change every day, and market makers will happily use Senate delays to spook the crowd. You have to be ready for this and use that fear as an entry point. Friends, Warren Buffett once said that the stock market is a device for transferring money from the impatient to the patient. In the crypto market, this rule works tenfold. What you are feeling right now, boredom, doubt, the urge to sell everything and forget about itis normal. It's the psychology wired into us by nature. But right now, at this very moment, while the charts are frozen and bankers are battling crypto innovations in the halls of the Senate, the fate of the next bull run is being decided. The Clarity Act isn't just another piece of paper. It's a bridge between the old financial world and the new one. And while the spring on the chart is winding up, you have time to decide which side of this bridge you want to be on when it's finally built. If you appreciate this kind of deep Divino fluff, just real facts, and an understanding of market mechanics, make sure to hit the like button on this video. Let me know in the comments. Do you think the banks will manage to block the bill? Or has crypto already won? I'd love to read your thoughts. Subscribe to the channel. Hit the bell icon so you don't miss the emergency update when this triangle finally breaks. Trade smart, manage your risks, and remember, the calm always comes right before the storm. See you in the order book.